So today I wanted to talk about the potential for lowering interest rates and how that can affect a certain sector of the stock market. A year ago, interest rates were 5% and they've fallen down to 4%. And Trump is really trying to get the Fed to lower interest rates even further. He'd like them down at 1%. I just thought I'd talk, if the interest rates really are going to go lower, there's some things you can do to get ready in advance for that and potentially have a gain. And that concerns dividend paying stocks. So right now there's a lot of retirees that have cash and they can just store them in a money market account and earn 4%. It's not as good as 5%, but it's much better than it was before 2020 when interest rates were so low that you just couldn't get a yield enough to live on like you could decades ago. And so in the mid 2018, 2019, 2020s, there was a statement that was called TINA, which stands for there is no alternative. And so thinking about that a little bit, right now there are people that are getting a yield by just keeping their money in money market accounts. They can put it into CDs, they can also put it into government T-bills and kind of get this 4% range, which, if you have $1 million saved, that's $40,000 a year. If you have $2 million, that's $80,000 a year. There's a lot of retirees that have that much, and without risking anything, they can just put their money in those money market accounts and T-bills and kind of earn enough to live on. So if Powell or the Fed ends up cutting rates from 4% down to 3%, well, that starts to make a difference into the lives of people who have all these, have their money in money markets. So, going from, if you have $1 million, from $40,000 a year down to $30,000 a year, that's kind of a painful cut. And so, if the Fed rate lowers from 4% down to 2%, well, that's even harsher. And so, when rates are low, then retirees and other folks with income start to look at other investments to try to replace that yield. And that's why that TINA acronym came, because they couldn't earn enough money by keeping their money in a bank or in a money market account, and they had to buy something else. And so this can have an effect on good, solid dividend paying stocks. And so I've got three that are kind of an example right now. One of them is Chevron. The ticker is CVX. It has a dividend payment. I think it's a little above 4%. It might be 4.5%. I don't know exactly what it is. Another one is Southern Energy. Its ticker is SO. It's got a dividend yield, I think, of just below 4%. And another one is, or it might be actually a little above, I can't remember. Another one is Kinder Morgan. That stock is KMI. I think its dividend yield is right around that 4% range. And so, if you own one of these stocks right now, your yield, you get about 4% per year, or if you own a money market account, you get 4% per year. But if the Fed lowers interest rates, two things kind of happen to these stocks. Number one, retirees start looking around for income. They may not be able to stomach or live off of a 3% rate per year, even though it's safer, and they're going to need extra income. And so one possible source for that is to look at stocks with high dividends. So that can have an effect on the share price of these dividend stocks, because as retirees look for places to get income, they'll tend to buy fairly safe value type stocks that pay these dividends. So you could see the value of Chevron or Kinder Morgan or Southern Energy go up because more people are trying to buy them, and they'll kind of continue to percolate up until their dividend yield kind of neutralizes with whatever you can get from interest rates. So as the price appreciates in a stock, the stock's still paying out the same number of cents per share. So the end result is the dividend yield will go down as the price comes up, even though the shares still pay the same amount. So if you get in a little bit earlier, kind of thinking, hey, I do think interest rates are going to fall, that you can still kind of lock in that 4% rate now, and then as the Fed lowers rates and people start to look for other sources of income, you're already in the shares, and then you can get the appreciation for those shares. So Companies also try to increase the dividend slightly each year. So I think Kinder Morgan just increased their dividend by 2% this year. I think I saw that today. So, slowly over time, what was a 4% yield could turn into a 4.2% yield and a 4.4% yield. And so kind of stay ahead of inflation. So that's just some food for thought. If interest rates really are going to fall, that makes these older dividend paying large companies more attractive. And there's several out there that pay somewhere between the 3% to 4% yield. And if rates truly are going to fall from 4% right now all the way down to 1%, it's going to force a lot of retirees and folks with money to look for alternates to generate the income they need to live on. So they are going to be looking for safe, reliable income streams over time. So now may be a good time to kind of, if you think interest rates are going to drop, start looking for some of these alternatives. I guess I also should mention that I really like oil pipeline stocks. These are midstream companies. Their dividend yields are higher. They're kind of in the 6% to 8% range typically. They will also benefit from this. And I also should mention that if interest rates fall, that will also benefit these large companies because it will make their debt less expensive. Yeah, sorry about the dog. He does not like me here, but we're still going to walk here anyways. So, let's say Kinder Morgan is borrowing money right now at 6%, a couple percentage points higher than the interest rate. Well, if the interest rates fall, then they can refinance their debt or get lower bond yields, and thus everything becomes cheaper. I've got a lawnmower next to me too, but I'm just going to keep talking over this because it's an important principle. So lower interest rates will also make these companies more valuable because they can get debt cheaper. Their expenses go down. So, a Chevron or a Southern or a Kinder Morgan, as their debt gets cheaper, then they get to harvest and keep those gains. So that's another fan beneath the flames of these stocks is their expenses go down and people start looking at them for the sake of their stable, cheap dividends. So kind of take a look at that. We're in that time where the Fed might lower interest rates, and if they do, it's going to make a lot of dividend stocks much more attractive to retirees who no longer can live off the dividend income, or not the dividend, but the interest income that we're going to get from T-bills or money market accounts. They're going to need to go into something. So, food for thought. This isn't financial advice. It's just kind of me thinking out loud, and at a possible response could happen. And wish you well on your investing journey. We'll see you. Bye.